Look at these two grocery receipts. Same exact items, same store. The one on the left is from 2015. The one on the right is from 2025. The total went from $28 to almost $40. That's a 40% increase, and you didn't buy a single extra item. Something invisible has been stealing from you for your entire life. And today, I'm going to show you exactly what it is, and more importantly, how to fight back. This is Trovest Academy, a 60-episode series that will take you from knowing absolutely nothing about investing to analyzing stocks like a professional. No jargon without explanation, no assumptions about what you already know. This is Episode 1, Module 1, the foundation. Before we talk about stocks, ratios, or analysis, you need to understand the single most important reason why investing isn't optional. It's about survival. Let's get into it. Inflation is the gradual increase in prices over time. It means the same dollar buys you less and less as the years go by. Think of it this way. Your dollar is literally shrinking, not physically, but in terms of what it can actually purchase. In the United States, inflation has averaged roughly 3.2% per year since 1926. That might sound small. 3%? Who cares? But here's the thing about percentages. They compound. And when something compounds against you year after year after year, the damage is enormous. Let me show you exactly how enormous. Let's take $100 from 2005 and follow it through time. If you took that $100 bill and stuffed it under your mattress, did nothing with it, just kept it safe, here's what happened to its purchasing power. By 2010, your $100 only bought about $88 worth of goods. By 2015, it was down to $78. By 2020, roughly $70. And by 2025, that same $100 bill buys you about $63 worth of stuff. You didn't spend a penny. You didn't lose the bill, but you lost $37 in real purchasing power just by doing nothing. That's the brutal math of inflation. Doing nothing is not playing it safe. Doing nothing is guaranteed loss. The government tracks inflation using something called the Consumer Price Index, or CPI. It measures the average cost of a basket of everyday goods and services: food, housing, transportation, healthcare, the things you actually spend money on. Look at this chart. 20 years of CPI data. The trend is unmistakable. It goes up and up and up. There are brief dips during crises like 2008 and early 2020, but the overall direction never changes. Prices always recover and keep climbing. Notice that steep section around 2021 and 2022, that's when inflation spiked to over 9%. People felt that one. But even in normal years, it's quietly chipping away at 3 to 4%. Here's where most people get tricked. You put your money in a savings account. The bank says you're earning 0.5% interest. You see your balance go up a tiny bit. You feel responsible. You feel safe, but you're not safe. You're losing money. Here's the formula that changes everything. Your real rate of return equals your nominal return. That's the number the bank shows you, minus inflation. So if your savings account pays 0.5% and inflation is running at 3.5%, your real return is negative 3%. You are losing 3% of your purchasing power every single year while the bank tells you you're earning money. That's the savings account trap. The number in your account goes up, but what that number can actually buy goes down. It's an illusion of safety. Let me make this painfully real. Imagine it's 2005 and you have $10,000. You have two choices. Path A, you put it in a savings account earning 0.5%. After 20 years, your account shows about $11,000. Looks like you made money, right? But adjusted for inflation, that $11,000 only buys you about $6,900 worth of stuff. You lost purchasing power, you went backwards. Path B, you invest it in an S&P 500 index fund, which has historically returned about 10% per year on average. After 20 years, that $10,000 grew to roughly $67,000. Even after adjusting for inflation, your real purchasing power is over $42,000. Same starting amount, same 20 years. One path gave you 6 times more real wealth than the other. That's not a small difference. That's life-changing. Let's zoom out to the big picture. Here are the average annual returns of major asset classes over roughly the last 100 years. Stocks have returned about 10% per year. corporate bonds about 5.5%, government bonds about 5%, gold around 4.5%, and savings accounts roughly 1.5%. Now look at that red line. That's inflation at 3.2%. Everything below that line is losing purchasing power. Savings accounts, losing. Even government bonds barely keep up some years. The only asset class that consistently and significantly beats inflation over long time periods is the stock market. This isn't opinion. This is 100 years of data. And that's why we're here. That's why this series exists. I want you to think about inflation like a moving walkway at an airport, except it's going backwards. If you just stand still, which is what a savings account does, you're being carried backwards. You're losing ground every single day. Bonds are like walking slowly on that backward walkway. You might stay roughly in place, but you're not really getting anywhere. Stocks are like jogging forward. You're actually making progress. You're outpacing the walkway and moving ahead. The key mindset shift is this: preserving your purchasing power is the #1 job of your money. And the only reliable way to do that over the long term is to invest. Now, I know what some of you are thinking, but stocks are risky. The market crashes. People lose everything. Let me show you something. This is the S&P 500 from 1926 to today. That's roughly 100 years. Yes, there are crashes. Brutal ones. 1929, 2008, 2020. The market has dropped 30, 40, even 50% multiple times. But look at what happens after every single crash. It recovers every single time. Not just recovers, it goes on to set new all-time highs. The market has been positive in about 73% of all calendar years. The long-term trend is unambiguously up. The risk isn't investing in stocks. The risk is not investing and letting inflation eat your wealth for 40 years. Here's a quick trick that will change how you think about money forever. It's called the Rule of 72. Take the number 72 and divide it by your annual rate of return. The result is roughly how many years it takes to double your money. Savings account at 1%, 72 divided by 1. 72 years to double your money. You'd need a lifetime. Bonds at 5%, 72 divided by 5, about 14.5 years. Stocks at 10%, 72 divided by 10, just 7.2 years. Your money doubles roughly every 7 years. Think about that over a full lifetime. In 72 years, a savings account doubles your money once. Stocks double it 10 times. Once versus 10 times. That's the power of a higher return rate compounding over time. Here's how I want you to think about your money from now on. Every dollar you have is an employee, and right now most of your dollars are sitting on the couch doing nothing, earning 0.5%, getting eaten alive by inflation. When you invest, you're putting those dollars to work. They go out and build more dollars, and those new dollars go out and build even more. That's compounding. Your money creates money that creates more money, but it can only do that if you actually put it to work. A dollar sitting in a savings account isn't safe. It's unemployed. So how do you actually find companies that beat inflation? This is where it gets practical. On the Trovest platform, every company is scored across 10 different metrics. 2 of them are especially relevant to what we just talked about. The Growth Outlook score measures whether a company is growing its revenue and earnings significantly faster than inflation. If inflation is running at 3% and a company is growing earnings at 15 or 20%, that's a company that's building wealth for its shareholders. The profitability score shows you companies with strong margins and pricing power, businesses that can actually raise their prices along with inflation without losing customers. These are the kinds of businesses that don't just survive inflation, they thrive in it. And Trovest helps you find them with real data, not guesswork. There's a link in the description if you want to explore it. Over the next 60 episodes, you're going to learn everything: how to read financial statements, how to value a company, how to spot red flags, how to identify the best stocks from the worst, how to build and manage a real portfolio. By the end of this series, you'll be able to look at any public company and know, with data and confidence, whether it's a good investment or not. You'll analyze stocks the way professionals do. And the best part? Every single concept builds on the one before it. No skipping ahead, no gaps. It all connects. Let's lock in the 3 things I want you to take away from this episode. Number 1. Inflation silently destroys your wealth at roughly 3% per year. It never stops. It never takes a break. Number 2. Savings accounts lose purchasing power. The so-called safe choice is actually the riskiest thing you can do with your money over the long term. Number 3. Investing in stocks is the proven way to beat inflation over time. 100 years of data backs this up. The bottom line, doing nothing is not playing it safe. Doing nothing is the riskiest financial decision you can make. In the next episode, we're going to answer the question that most people think they understand but really don't. What is the stock market, actually? I'm going to explain it using a pizza shop, and by the end, you'll understand stocks better than most people who have been investing for years. Hit subscribe so you don't miss it. And if you want to start exploring real company data right now, check out Trovest. The link is in the description. See you in episode 2.